A good day to everyone, and as always, welcome to our weekly market update provided by ASPI Securities. As always, we will take you through the happenings of the market this week, as well as some information pertaining to the economic aspect of the news before we delve into some of the secondary market or Forex market, and then followed up by a global commodities watch or news roundup, and then finally touching upon the global market news. This week as well, we will be continuing our commodity watch, and Harin will be taking you over the commodity counter that we have selected for this week before he goes over the notions for the ASPI and our pick of the week this week. So without further ado, let's delve in. The headlines for this week, correction in the works. So the ASPI this week actually ended in the red as investor sentiment took a bit of a downward spiral. The ASPI actually fell by 3.93% this week, whilst the S&P fell by 3.39% this week. So really, the week started off in not such great fashion. It continued the losing trend or downward momentum that it had experienced on Friday the week prior. Before we actually saw some significant negative turn in the market on Tuesday and Wednesday. So in our opinion, the bourse actually witnessed what we thought was a long overdue correction. And early days of the week, like I said, it ended in the red zone. Monday actually saw the market dip by 1% as further profit taking took place. Again, like we lamented that this was a pattern we saw on last Friday as well. But the real dip was seen on Tuesday and Wednesday. Tuesday, we saw the all-share fall by 135 points, whilst on Wednesday, it fell by drastically 328 points. So this was mainly on the back of a combination of two things: continued profit taking, coupled with investor concerns over currency stability. Export earning companies such as Expo and Haley's can be particularly hampered with a pegged currency. Now, what that means is that the Central Bank of Sri Lanka decided to introduce the peg scheme for the rupee and keep it at a level of 203. And that would actually hamper most of these export earnings, as the rupee, a depreciating rupee actually makes for export competitiveness. The tumble was also further exacerbated by the fact that it was the index biggest gainers over the last couple of weeks that actually contributed to the fall as well. So now on Wednesday alone, if you look at the main contributors towards the downfall, Expo contributed 55 points, LOLC contributed 54, Bill and Haley's contributed 39 and 16 points respectively. So these were the main the bull market drivers, but they also seem to have played an integral part in the correction. Thursday actually saw the bourse actually rebound. Now, it actually rebounded by 222 points, which actually suggests that the downturn in the market witnessed on Wednesday was somewhat of an overreaction. So really, on Thursday, what we saw was investors actually take advantage of that overreaction and actually collecting some of these fundamentally sound stocks. A noteworthy point on Thursday is that we actually saw significant foreign buying in Nestle, and this was one of the top contributors towards turnover. From what we understand, it is the company itself who are buying these shares back, which leads us to the conclusion that if they are looking to buy back these shares, there might be a chance of Nestle actually delisting. Friday actually saw the index retrace as profit taking took place, coupled with some investor trepidation. And how we see the market, especially in this week, and that has kind of affirmed it, is that it is quite volatile now. The market has entered that stage of volatility. So in our opinion, what we say is you need to exercise caution. The sell-off that occurred in the market was somewhat of an overreaction, but it is also resultant of the fact that the index was thoroughly overheated, which is something that we have been saying for the past 2 weeks. So for anyone who is participating in the market, what the best advice that we can give you is tread with caution. In terms of other new worthy highlights, foreign net outflows for the week came in at 664 million. Now, on Thursday, as we said, there was a net foreign buying actually on the back of that buying action that happened on the Nestle counter. Turnover for the week actually came in quite low compared to the last 2 weeks. but that is to be expected. Moving on to some of the economic news, what we've highlighted are on two announcements made by the central bank this week. So the headline read, roadblocks ahead as central bank imposes fresh restrictions on imports. But before we get to that, the central bank actually put out two circulars on Wednesday. The first one being that they have officially pegged the rupee at a fixed rate in the region of 200 to 203. In a letter sent across by the governor, he conveyed that banks must comply to this new measures whilst efforts were being made to boost foreign inflows. Now, prior to the announcement, the dollar was being quoted somewhere in the range between 225 to 235. The benefits that do arise from such a rate is that the country's debt stock will come down overnight, or basically the pegging of the rupee will be that the country's debt stock will come down overnight whilst imports become cheaper. So therefore, what we call cost push inflation arising from imports would actually be falling. But the downside here is that on the other side, it reduces the export competitiveness because technically the rupee is now at a higher or has appreciated in value. What we have understood is that they will try to keep the fixed rate in place till December, but exporters will now be forced to convert their earnings rather than delaying them on speculation of further depreciation. Furthermore, on Wednesday itself, the central bank also confirmed that it has opted to impose a 100% cash margin deposit requirement on the importation of what they deem to be non-essential or non-urgent goods with immediate effect. Additionally, banks have been barred from giving credit for importers to meet the margins. The new restrictions apply to some close to around 690 items. This will most definitely have an impact on retailers who import such goods, but we need to highlight that the impact will mainly be felt by the small to medium-sized companies. Because if you look at the larger companies that operate in the space or import these goods, such as electrical goods or air conditioners, TV, smartphones, companies such as SoftLogic Retail, Barnes, Singer, they have the capital buffers to actually buy these goods outright. So they may incur some losses, absolutely, but nowhere near as much as the small to medium-sized players. At the time of publishing this report, to be honest, we do not have any further indications as to whether there will be additional restrictions placed upon imports moving forward. There have been some rumblings in the market, but as of now, that we haven't been able to corroborate any of those rumors. So if we look at the bond or the Forex market is actually in a slumber mode, to be honest, and the Forex market remained largely inactive following the central bank's request to keep the rupee pegged. Industry leads such as Bank of Ceylon and People's Bank have not done any major transactions, including the opening of further letters of credit or LCs. The banks have continued to face difficulties in getting foreign exchange from exports and remittances after the revaluation. And market insiders have stated that the banks were forced to ration dollars as supplies continued to remain weak. So this is definitely an area that we do need to keep a fixated eye on. If we look at the commodities market, so oil prices earlier this week. So the main highlight, of course, again, is aluminium, but we will get to that. Before that, oil prices earlier this week observed a slight dip, firstly on Monday, as Saudi Arabia actually slashed prices for Asia, citing that the global markets are now well supplied. This momentum continued on to Tuesday due to the continuing strength of the dollar. However, we saw this offset midweek as prices rose up due to a continued slowdown in US production in the Gulf of Mexico following Hurricane Ida. Gold prices, which we actually focus on this week in our commodity watch, hit a 2-week low on Thursday as stronger US dollar weighed in on prices. However, we do not see this fall being sustained as investor trepidation persists. So investor sentiment is still somewhat mixed when it comes to the global economic recovery effort. So therefore, gold may see somewhat of a topsy-turvy momentum moving forward, which is why we've actually decided to have a look at that counter this week. Aluminium prices, which is our headline, hit a 13-year high this week, actually jumping up by 145 US dollars. This was mainly due to continued supply cuts from China, which we've harped on quite continuously over the last 3 or 4 weeks. But really, this was exacerbated by major disruptions into the supply chain from a major producer of bauxite, which is the raw material needed to harness aluminium, and that being Guinea, who is currently undergoing political instability in the form of an attempted military coup. And finally, in terms of the global market watch, Asian markets actually ended the week strong on the back of news pertaining to a candid call between Presidents Biden and Xi Jinping. The Hang Seng actually rose by close to 2% on Friday, whilst the China Enterprise Index gained 2.2%. This follows a mixed week for Chinese markets that started off strong, buoyed by better than expected export figures from China. However, this momentum was broken up midweek by a slump, primarily driven by a slowdown in tech stocks, which can be attributable to the government's new crackdown on gaming. European stocks actually ended flat on Thursday, dropping by nearly 1% on the back of the European Central Bank signaling it will taper off its emergency bond purchases over the coming quarter. This was widely expected, which resulted in the index not declining as sharply. The pan-European stock 600 ended the session barely below the flat line after falling by 0.8% earlier during the day. And whilst finally on Wall Street, US stocks still remained in the mix as investors still remain cautious over the economic recovery efforts globally. Those are our main major highlights this week, and I will now hand it over to Harin, who will go over our commodity watch this week, which is gold, before he goes over the notions for the ASPI and our pick of the week this week, HMB non-voting shares. Over to you, Harin.
All right. Thank you very much, Nuwan. So we'll just start off with gold and see how gold has been moving over the past few days and what has happened in gold during the past few days. So 2 weeks back when we touched gold, we saw that the price is actually trying to break the key level of 1,797,800 key area. So we were able to see that price getting breaking that key area of that supply zone and then heading towards the daily resistance 1,840, 1,860. So now as we look into it, we were able to see on 3rd September the price made a high of 1,834 and started to decline again. So once the price has come down again below the 1,800 psychological area. So if the price sustains below that 1,800 psychological area, price could eventually come down again to the daily support level 1,740, 1,760, that key area. If the price manages to sustain over 1,800, we'll be able to see it moving up again towards the daily resistance 1,840, 1,860. So as we look at gold in a bit of zooming out from the chart and looking at it, we can see that how the price has been consolidating over this region for the past few weeks. So starting from June itself, we were able to see the price making some highs at 1,840, and then price declining again, once broke the daily support level and came above the daily support level and started trading above that key level. At the moment, gold seems to be pretty much over the past few weeks consolidating over this key region of 1,740 and 1,840. So these are the key levels where the gold seems to be actually consolidating. So here we have a downward trend, and that the downward trend has been broken, and now we do have a clear retest over here. So the price actually needs to sustain over 1,800, then we'll be able to see gold moving towards the daily resistance of 1,840, 1,860. So currently the RSI is in the mid range, and the RSI is actually at around 50 levels now. So looking at the all share index, we were able to see on 3rd of September, we were able to see it made a new all-time high, which is 9,425.62. So after making that all-time high on that day, we were able to see a bearish spinning top formation where the price, where the index continuously declined and went below the psychological area of 9,000, 9,050. So we were able to see it again today, making somewhat around a retest towards the daily resistance of 9,000, 9,050 at the moment. So index needs to sustain above that key level of resistance 9,000, 9,050 in order for us to see whether it would continue its bullish momentum and break the previous high. Else, if the index if the index trades below the daily resistance 9,000, 9,050, or even if it breaks today's low, which is 8,838.95, if it goes below those key levels, we'll be able to expect it coming towards to the daily support level of 8,550, 8,600. So looking at the moving averages, we can see that how the index is at the moment. So index at the, so looking at the ATMA, the index is somewhat below the ATMA and above the 18 EMA. So if it comes below the 18 EMA as well, whereas the both 8 and 18 EMA, if the index trades below both those EMA levels, then the index could further decline towards to the daily support level 8,550, 8,600. So the daily RSI has cooled down a lot, whereas previously we were able to see it was at a pretty much overheated territory, and which is those key areas which is 83, 80 plus. We were able to see RSI actually in the overbought region, which is 80 plus, and now the RSI has come down to around 55.9 in the daily chart. So next would be our pick of the week, which is HNB non-voting again. So HNB non-voting, we were able to see how the price actually moving above the monthly resistance, previous monthly resistance 115, 125, and now it has officially made it the monthly support level. So here we do have a symmetrical triangle formation. That symmetrical triangle formation has been broken out, and now the price seems to be slowly moving towards to the weekly resistance of 140, 145. So soon as the price actually trades above 131.25, which is previous last month's high, which is 131.25, will be able to see the price moving to the weekly resistance of 140, 145. So the RSI the monthly RSI comes to a level of 57.8, and at the moment also we can see, looking at the moving averages, there is somewhat around a crossing where the 8 EMA has crossed the 18 EMA, which indicates a bullish momentum. So the last previous crossing happened into somewhat around 2018 June. So now that there's a crossing and the price is trading above this strong monthly support level 115, 125, we'll be able to expect the weekly resistance of 140, 145, and even further, if that key level breaks, the monthly resistance of 160, 170 could be tested once again. Thank you. Over to you, Nuwan.
Thanks, Harin, for that update. Insightful as always. And thanks everyone for joining us again this week. We really appreciate your continued patronage. And please do give us a follow on our social media platforms. We inundate this weekly, not just with the weekly update, but with our flash notes as well. So if anyone wants to get an insight into the latest inflation figures or even the cash margin announcement done by the central bank, please follow us on these platforms where we share this content with y'all. And we look forward to having y'all again next week. Till then, take care.